Right now, while headlines say the economy is stable, a silent mechanism is pulling cash out of the real economy, one credit line at a time. Businesses are not failing because they stopped making money. They're failing because the oxygen, liquidity, is being cut off. Regional banks are tightening, loans are disappearing, and thousands of small companies are running out of runway without ever making the news. The frightening part is this. By the time most people realize what's happening, the exits are already closed. Because this isn't a crash you see on TV, it's a slow drain you only feel when the cash stops flowing. And the real question is, who survives when credit quietly disappears and who doesn't? Welcome to Market Metal, where we break down the signals before they become headlines. If you've spent a lifetime building your savings or your business, do me one small favor. Tap that subscribe button so you never get blindsided by changes that happen quietly behind the system. And tell me in the comments, where are you watching from today? The mechanism. How liquidity actually moves through the real economy. The discussion begins with a basic truth that is often misunderstood in the business world. Most people believe that a business fails because it stops making profit. They assume that as long as sales are strong and customers keep buying, the company is safe. But history shows a different pattern. Businesses rarely collapse because of profit alone. They collapse when cash stops moving. They collapse when liquidity disappears. Liquidity is not a complex idea. It simply means having enough cash available at the right time to meet immediate obligations. Payroll must be paid every 2 weeks. Suppliers expect payment on fixed dates. Rent does not wait for customers to settle invoices. Taxes have deadlines. These obligations arrive on schedule whether revenue arrives or not. This timing gap is the hidden pressure point inside most small companies. Revenue often comes in later than expenses go out. A contractor may complete a project today, but receive payment 30 or 60 days later. A distributor may ship goods now but collect cash next month. During that waiting period, the business must continue operating. Workers must be paid. Inventory must be replaced. Utilities must stay on. The business survives that gap by using liquidity. In practice, liquidity usually comes from credit. For decades, regional and community banks have provided that bridge. They offer business lines of credit, short-term loans, and working capital facilities. These tools are not luxury financing. They are operating oxygen. They allow a business to function between the moment it delivers value and the moment it gets paid. Without that oxygen, even a healthy company can suffocate. Small businesses operate on thin margins. Many earn net profits between 5 and 10%. That means there is very little room for delay or disruption. If one large customer pays late, the effect is immediate. Cash balances shrink. Decisions become reactive. Managers begin delaying payments or drawing down reserves. The situation can stabilize if credit is available. It becomes dangerous if credit tightens. This is where the concept of the liquidity mismatch becomes critical. A liquidity mismatch happens when short-term obligations must be paid before incoming cash arrives. The business may be profitable on paper. Its income statement may look strong, but its bank account tells a different story. The company has revenue booked but no cash in hand. When a bank provides a revolving credit line, that mismatch is manageable. The company borrows for a few weeks, covers payroll, pays suppliers, and then repays the balance when customer payments arrive. This cycle can repeat for years without issue. Many stable companies rely on this rhythm as part of normal operations. The risk appears when the credit mechanism changes. Banks do not always maintain the same lending posture. Their willingness to extend credit depends on their own balance sheet health, regulatory pressure, and market conditions. When banks feel strong, credit flows easily. When banks feel stress, they become cautious. They reduce exposure. They raise rates. They tighten approval standards. For a large corporation, this shift is inconvenient but not fatal. Large firms can issue bonds, sell equity, or access capital markets directly. They have multiple funding channels. Small businesses do not. Most rely on 1 or 2 local banking relationships. If those lenders pull back, alternatives are limited and expensive. This structural dependence creates a fragile link in the real economy. When a regional bank reduces a credit line, the decision is rarely dramatic. There is no public announcement, no headline appears. The bank simply lowers the available balance or declines renewal at maturity. From the outside, nothing seems unusual. Inside the business, the impact is immediate. The owner reviews cash projections and realizes that next month's payroll no longer has a safety buffer. Supplier invoices begin stacking, purchasing slows, hiring freezes. The company may still have strong sales, but operational flexibility disappears. At this stage, many businesses try to adapt. They delay vendor payments. They ask customers to pay faster. They reduce inventory orders. These actions can buy time, but they also create stress across the supply chain. A delayed payment for one company becomes a cash shortage for another. Liquidity problems rarely stay contained. They spread through networks. If credit conditions continue tightening, the business eventually faces a hard constraint. Obligations exceed available cash. At that moment, Profitability no longer matters. Even a profitable firm can miss payroll or default on a loan. Once that happens, confidence drops quickly. Suppliers demand stricter terms. Employees begin searching for more stable jobs. Customers sense instability. The downward spiral accelerates not because demand vanished, but because liquidity vanished. This dynamic has repeated across many economic cycles. Analysts often describe recessions in terms of falling sales or declining GDP, but beneath those large indicators is a more precise mechanism. Credit expands during growth periods and contracts during stress. When contraction reaches small businesses, the effects become visible in layoffs, closures, and bankruptcies. Understanding this mechanism requires shifting perspective. Instead of asking whether companies are profitable, the better question is whether they can access cash when they need it. Profit is a long-term measure. Liquidity is a daily survival requirement. The role of regional banks becomes central in this framework. These institutions are deeply connected to local economies. They know their borrowers personally. They finance equipment purchases, seasonal inventory, and working capital. In many regions, they provide the majority of small business loans. Because of this concentration, any stress within regional banking quickly affects local commerce. If banks face rising loan losses or deposit outflows, they must protect their balance sheets. The fastest way to do that is to reduce new lending and limit existing exposure. From a risk management perspective, this behavior is rational. From a small business perspective, it can be devastating. The reduction in credit does not appear all at once. It happens gradually. One loan officer becomes stricter with collateral requirements. Another declines a renewal that would have been routine a year earlier. Interest rates on new facilities rise. Each individual decision seems minor. In aggregate, they create a broad tightening. By the time business owners recognize the pattern, options are fewer. At the macro level, policymakers monitor these changes through lending surveys and credit condition reports. These indicators often move before employment data or consumer spending figures. They act as early signals of economic stress. When a high percentage of banks report tighter standards, it usually means liquidity is contracting across the system. For small firms, the experience is more personal. They notice slower approvals, smaller limits, and higher costs. Conversations with lenders become cautious. Terms include more covenants and more documentation. The relationship shifts from supportive to defensive. This shift marks the beginning of a liquidity crunch. A liquidity crunch does not require a market crash or a dramatic event. It can develop quietly as credit availability narrows. Businesses continue operating, but with less margin for error. Cash reserves become more valuable than growth plans. Expansion projects are delayed. Risk tolerance declines. Over time, this environment favors companies with strong balance sheets and diversified funding. It pressures those that rely on continuous access to short-term credit. The difference is not management quality alone. It is structural positioning within the financial system. The central lesson of this mechanism is straightforward but often overlooked. Cash flow timing determines survival more than reported profit. Credit availability determines whether timing gaps are manageable or fatal. When liquidity flows smoothly, businesses grow. When liquidity tightens, even efficient firms can fail. For decision makers, this understanding changes priorities. Monitoring revenue is not enough. They must also track cash cycles, credit terms, and banking relationships. They must treat liquidity as a strategic resource rather than a background assumption. In periods of tightening, the companies that endure are usually those that recognize the shift early. They reduced dependency on a single lender. They increased cash buffers. They adjusted operations to function with less borrowed capital. These actions do not eliminate risk, but they extend survival time. The mechanism is not dramatic, but it is powerful. Liquidity enters quietly through credit channels, and it can leave just as quietly when those channels narrow. By the time the effects appear in public data, many businesses have already felt the pressure. This is why understanding liquidity is essential for anyone operating in the real economy. Profit measures performance, but liquidity determines whether the business can continue long enough for that performance to matter. The current environment, why the liquidity crunch is forming. Now, the situation did not begin with a single headline or one dramatic failure. It developed quietly, layer by layer, inside the balance sheets of regional banks. To understand why the liquidity crunch is forming now, the focus must shift from business performance to the health of the institutions that supply credit. When lenders feel pressure, credit tightens. When credit tightens, small businesses feel the impact first. The stress that is shaping the current environment can be traced back to the banking shock of 2023. Several regional institutions experienced sudden deposit withdrawals and were forced into emergency actions. Public attention moved on after the immediate crisis passed, but the underlying pressures did not disappear. They settled into the system and continued working in the background. Regional banks depend heavily on deposits for funding. When depositors become cautious, they move funds toward larger institutions or into higher yield alternatives. Even a slow but steady outflow forces banks to defend their liquidity. They respond by conserving capital, increasing lending standards, and reducing exposure to loans that carry higher risk. Small business credit falls into that category. At the same time, another pressure point has been growing. Many banks accumulated long-term bonds during the years when interest rates were near historic lows. Those securities appeared safe when yields were minimal. However, when interest rates rose rapidly, the market value of those bonds declined. The losses were often labeled as unrealized because they did not appear immediately on income statements. Yet the losses still existed. If a bank is forced to sell those securities to meet withdrawals, the losses become real. That realization can weaken capital ratios and threaten regulatory thresholds. To avoid that outcome, banks attempt to reduce the chance of needing to sell. The simplest path is to hold more liquidity and issue fewer new loans. This defensive behavior does not make headlines, but it changes the flow of credit across the economy. Another source of strain comes from commercial real estate exposure. Many regional institutions financed office buildings, retail centers, and local development projects during expansion years. As property values adjusted and occupancy rates changed, the risk profile of those loans shifted. Refinancing became harder. Default probabilities increased. Each troubled loan required more reserves and closer monitoring. Under these conditions, lending committees begin to prioritize preservation over growth. They favor borrowers with the strongest collateral and the lowest perceived risk. Small businesses, which often rely on future revenue rather than hard assets, appear less secure from a regulatory standpoint. Even companies with steady customers may face stricter terms. This is why small business lending is often reduced before other types of credit. Residential mortgages are supported by collateral that is easier to value. Auto loans are standardized and widely distributed. Corporate bonds can be sold into broader markets. A local manufacturer or service company, however, depends almost entirely on its relationship with a regional bank. When that relationship changes, the company has few alternatives. The tightening does not arrive in a dramatic wave. It moves through subtle adjustments. Credit lines that once expanded with business growth begin to plateau. Renewal discussions include new covenants. Interest spreads widen. Loan officers request additional documentation that was not required before. Each change appears procedural, yet together they form a clear pattern. Data from lending surveys often confirms what business owners sense anecdotally. A rising percentage of banks report stricter underwriting standards. Approval rates decline, borrowing costs increase. These shifts tend to occur months before broader economic indicators reflect stress. By the time employment or consumer spending data weakens, credit has already been contracting. The cost of borrowing has also changed in a meaningful way. Interest rates on small business loans have moved from levels that were manageable within thin margins to levels that consume a large share of operating profit. For a company earning modest net income, a doubling of financing costs can erase flexibility. Projects that once generated acceptable returns become unviable. This is how a liquidity crunch begins to form even while demand still exists. From the outside, customers may still be placing orders. Revenue may appear stable, yet inside the balance sheet, the timing gap widens. More cash is required to service debt. Less credit is available to bridge delays. The margin for error narrows with each billing cycle. Another factor intensifies the pressure. Regulatory expectations often become stricter after a period of banking stress. Supervisors encourage institutions to strengthen capital positions and reduce risky exposures. Even if individual banks would prefer to continue lending, compliance concerns push them toward caution. The result is a synchronized pullback across multiple regions. This synchronization creates the appearance of isolated decisions, while producing a system-wide effect. Large corporations experience this environment differently. They can access bond markets, private placements, or international lenders. Their financing costs may rise, but access remains. Small enterprises do not share that privilege. They rely on relationship banking, local knowledge, and revolving facilities. When those channels narrow, operations become constrained. A two-tier credit structure begins to emerge. One tier includes firms with direct access to capital markets. The other includes firms dependent on regional lending. The gap between these tiers widens during periods of tightening. Over time, this divergence affects hiring, expansion, and competitive dynamics within entire industries. The most challenging aspect of the current environment is its quiet nature. There is no single event signaling that credit has seized. Instead, the contraction unfolds through thousands of individual decisions made inside lending departments. Each decision is rational from the bank's perspective. In aggregate, they reduce the flow of working capital across the small business sector. Business owners often recognize the shift only when a routine renewal becomes uncertain. A line of credit that had been stable for years is suddenly reduced or repriced. Conversations with lenders become more formal. The language shifts from partnership to risk management. This change signals that the institution is protecting its own balance sheet first. Once that shift occurs, rebuilding access to credit is difficult. The broader economic impact develops through a cascade. With less liquidity, companies delay inventory purchases. Suppliers receive orders later or in smaller quantities. Payment terms tighten across networks. Each participant becomes more defensive. The slowdown spreads, even if final consumer demand has not yet fallen. This chain reaction illustrates why liquidity conditions often lead economic cycles rather than follow them. Credit availability influences production, hiring, and investment decisions months before official data reflects contraction. By the time statistics confirm a slowdown, the liquidity squeeze has already reshaped behavior. Understanding the current environment, therefore, requires attention to signals that rarely dominate headlines. Deposit trends, bank capital ratios, lending surveys, and credit spreads provide early insight. These indicators show whether institutions feel confident enough to extend risk or compelled to conserve resources. At present, many of these signals point toward caution. Regional banks continue to manage unrealized losses and uncertain property exposures. Deposit competition remains intense as savers seek higher yields. Regulatory oversight emphasizes resilience. Together, these forces encourage lenders to tighten standards rather than expand credit aggressively. For small businesses, this translates into a more restrictive operating landscape. Access to routine financing becomes less predictable. Costs rise. Flexibility declines. Even firms with stable demand must operate with greater discipline because the safety buffer provided by credit is thinner. The liquidity crunch does not announce itself with a single moment. It forms gradually as each protective decision accumulates. By the time its effects are widely recognized, many companies have already adjusted through layoffs, reduced orders, or halted expansion. This is why the current phase is both subtle and powerful. The system is not collapsing in a visible way. Instead, it is conserving capital and narrowing risk exposure. That process, while rational for lenders, withdraws the operating oxygen that small businesses depend on to function. When viewed together, the pressures from deposit movement, interest rate shifts, bond valuation losses, and commercial real estate risk create a consistent direction. Credit becomes more selective. Liquidity becomes more valuable. The margin between stability and distress becomes thinner. The environment is therefore not defined by a sudden shock, but by a steady tightening. And in such conditions, the difference between companies that endure and those that struggle often comes down to one factor: whether they can still access cash when timing gaps appear. The liquidity crunch is forming now not because demand has vanished, but because the institutions that supply credit are prioritizing survival. As they protect their own balance sheets, the flow of capital to smaller enterprises slows. The effect is gradual, but the consequences accumulate with each passing quarter. Historical parallels. What happens when local credit systems fail? The present environment can feel new because the signals are quiet and scattered. Yet when the pattern is placed against history, the sequence becomes familiar. Periods of credit stress rarely begin with dramatic collapse. They begin with hesitation inside local lending institutions. When those institutions withdraw support, the effects move through the real economy with a delay that hides the danger until it is already advanced. The first useful reference point appears in the early 1930s. Public memory often focuses on the stock market crash of 1929, but the deeper economic damage came later. The most destructive phase occurred when thousands of community and regional banks began to fail. These were not large investment houses. They were local lenders that financed farms, workshops, merchants, and small manufacturers across towns and counties. The sequence that unfolded was precise. Banks that had extended loans during the expansion years began to see those loans weaken as asset prices declined. Real estate values softened. Agricultural incomes dropped. As losses increased, bank managers shifted from growth to preservation. They reduced new lending and attempted to recover existing loans. This response was logical from their perspective. Preserving capital was the only way to survive. For borrowers, however, the change was severe. Small businesses that had relied on short-term credit suddenly faced demands to repay balances or provide additional collateral. Many of those companies were still producing goods and serving customers. Their operations had not stopped. What changed was their access to working capital. Without that bridge, they could not meet immediate obligations. The pressure then moved outward. As businesses missed payments, banks recorded more losses. Depositors noticed the stress and began withdrawing funds. Each withdrawal forced banks to sell assets at lower prices, which created additional losses. The system entered a feedback loop. Reduced lending caused business failures caused more losses caused further lending reductions. The result was a broad credit seizure that lasted several years. From a distance, it appeared that demand had collapsed first. In reality, the contraction in credit removed the ability of local enterprises to continue operating. Even companies with viable products could not survive the interruption in cash flow. The destruction of productive capacity followed the withdrawal of liquidity, not the other way around. A second historical parallel emerged decades later during the savings and loan crisis of the late 1980s and early 1990s. Savings and loan institutions had become primary lenders to real estate developers and many small businesses. During the expansion phase, they issued loans aggressively, often based on optimistic assumptions about property values. When economic conditions shifted, those assumptions proved fragile. Falling property prices weakened collateral. Loan defaults increased. Hundreds of institutions became insolvent. Authorities created liquidation mechanisms to resolve the failures. But those mechanisms focused on selling assets rather than extending new credit. The immediate priority was to stabilize the financial system, not to maintain lending relationships. For local businesses, the effect was delayed but decisive. Companies that had relied on those institutions for working capital discovered that their lines of credit would not be renewed. Some had stable revenue and long-standing customers, yet without access to short-term financing, they could not bridge seasonal cash gaps. Operations slowed, hiring stopped. Within months, many were forced into restructuring or closure. This pattern revealed a critical timing element. Banking stress often appears first in financial statements, then months later in employment and bankruptcy data. The delay creates a false sense of stability. By the time public indicators show deterioration, the credit withdrawal has already reshaped the operating environment. Businesses that did not recognize the early signals had little time to adjust. In both historical cases, the sequence followed a similar path. Asset values weakened. Lenders protected capital. Credit availability narrowed. Borrowers lost flexibility. Failures increased after the contraction had already taken hold. The order rarely changed, even though the specific triggers differed. Another consistent feature was the uneven distribution of impact. Large corporations, with access to bond markets and diversified funding, managed to continue operations. Their costs increased, but financing remained available. Smaller enterprises, dependent on local lending relationships, faced immediate constraints. The economy began to separate into tiers based on access to capital rather than quality of operations. This separation produced long-term consequences. Regions that lost community banking capacity experienced slower recoveries. New business formation declined. Existing firms postponed expansion. Capital flowed toward larger institutions and markets, leaving local economies with fewer growth engines. The credit system did not disappear, but it became less accessible to those without scale. Historical records also show that the most resilient operators shared certain behaviors. They reduced reliance on a single lender. They maintained higher cash reserves than competitors considered necessary. They treated liquidity as a strategic asset rather than an afterthought. These decisions did not eliminate exposure to downturns, but they extended survival time long enough for conditions to stabilize. Another group responded differently. Some investors recognized that periods of forced liquidation created unusual pricing. When banks or resolution agencies sold assets quickly, prices often fell below long-term value. Those with available capital and patience acquired properties, equipment, and operating businesses at substantial discounts. Their advantage came from timing and preparedness, not speculation. The lesson was not that crises create opportunity for everyone. The lesson was that liquidity determines who has the ability to act when others cannot. A further observation from past episodes concerns communication. During early phases of credit contraction, public messaging often remains calm. Authorities aim to prevent panic. Financial institutions emphasize stability. As a result, the severity of tightening may not be widely discussed until the effects become visible in employment or output data. By then, the structural shift is already in place. This communication gap contributes to delayed recognition among business owners. They continue planning based on conditions that no longer exist. Renewal discussions that once took days begin taking weeks. Approval processes include more conditions. These small frictions signal a larger change, but they are easy to dismiss individually. When viewed together, however, they form a clear pattern that history has documented more than once. Another recurring element is the role of confidence. Banking systems rely on trust between depositors, lenders, and borrowers. When that trust weakens, each participant becomes more defensive. Depositors seek safer locations for funds. Banks increase reserves. Borrowers conserve cash. These protective actions, while rational individually, reduce overall economic activity. Confidence, once reduced, tends to recover slowly. Historical timelines show that credit conditions often remain tight, even after the initial shock fades from headlines. Institutions rebuild capital gradually. Regulators maintain stricter oversight. Risk tolerance stays low. During this period, businesses that depend heavily on borrowed working capital face continued pressure. This persistence explains why bankruptcies in past cycles often peaked years after the original financial disturbance. The trigger event passed, but the contraction in credit continued to restrict operations. Recovery required not only improved demand, but also restored lending capacity. By comparing these historical sequences, the current pattern becomes easier to interpret. The presence of unrealized losses, cautious deposit behavior, and tighter underwriting standards fits the early stages observed before previous waves of small business distress. None of these signals alone guarantees severe outcomes. Together, they suggest a familiar trajectory. The central insight from history is therefore practical rather than dramatic. Liquidity systems do not fail suddenly without warning. They weaken through identifiable steps. Each step reduces flexibility for borrowers and increases caution among lenders. The cumulative effect becomes visible only after enough time has passed. For decision makers, recognizing the sequence matters more than predicting exact timing. Monitoring credit availability, deposit trends, and lending standards provides earlier information than waiting for broad economic statistics. History shows that those who acted during the early tightening phase preserved options. Those who waited for confirmation often faced decisions under constraint. The past does not repeat in identical form, but it often follows recognizable structures. Local credit systems, when under stress, tend to withdraw support first from the sectors with the least alternative funding. Small businesses occupy that position in most economies. Their experience becomes an early indicator of broader financial conditions. Understanding these parallels does not imply inevitability, it provides context. When current signals align with previously observed sequences, they offer a framework for interpreting events that might otherwise appear isolated. In that sense, history functions less as prediction and more as a map of how liquidity stress has moved through economies before. The pattern remains consistent. When local lenders retreat, the effects spread quietly at first, then more visibly. Operations continue until timing gaps can no longer be bridged. At that point, profitability becomes secondary to access. And once access is constrained, outcomes depend largely on who anticipated the shift early enough to adjust. Systemic consequences: how a liquidity crunch spreads through the economy. The final stage of a liquidity crunch rarely begins with a dramatic collapse. It begins with small operational decisions made under pressure. A business owner reviews the weekly cash report and decides to delay a purchase. Another reduces overtime hours. A third postpones a hiring plan that had been approved only weeks earlier. None of these choices appear significant on their own. Together, they mark the first visible shift from expansion to preservation. When access to credit narrows, the immediate response inside most small firms is defensive. Management focuses on protecting existing cash rather than pursuing growth. Inventory orders become smaller. Payment terms with suppliers are stretched where possible. Capital expenditures are delayed. These actions are rational, but they reduce activity across the network of companies connected to that business. The effect moves outward through the supply chain. A supplier that expected a routine order now receives a reduced request. That supplier adjusts its own purchasing schedule. Another vendor, waiting for payment, tightens its terms for other customers. What began as a single company conserving liquidity becomes a series of cautious decisions across multiple firms. Each participant is responding to local conditions, yet the combined outcome is a broad slowdown. Labor markets feel the change next. When liquidity becomes uncertain, payroll is the largest fixed cost most small businesses can control. Hiring freezes appear first. Temporary contracts are not renewed. Overtime is reduced. If the pressure continues, layoffs follow. These steps are not taken because demand has disappeared overnight. They occur because managers cannot risk committing to expenses without confidence in cash flow. Once households experience income uncertainty, spending behavior shifts. Workers who fear reduced hours begin delaying discretionary purchases. Large expenses are postponed. Savings rates rise as families build buffers. Retailers notice slower traffic. Service providers see fewer bookings. Demand weakens gradually, reinforcing the caution already present among businesses. The contraction feeds itself through reduced activity on both sides of the market. At this stage, the economy begins to separate into distinct tiers. Large corporations with access to bond markets and institutional capital continue financing operations. Their borrowing costs may increase, but liquidity remains available. Smaller enterprises, dependent on regional lending relationships, operate with tighter constraints. The difference is not necessarily efficiency or productivity, it is access. This divergence creates competitive imbalances. Firms with stable funding can maintain inventory, negotiate better supplier terms, and invest during periods when others are retreating. Smaller competitors, facing cash limits, lose flexibility. Over time, market share shifts toward organizations that possess stronger balance sheets. The structure of entire industries can change without any single dramatic event. Another consequence appears in pricing behavior. Companies under liquidity pressure prioritize immediate cash over long-term margins. They may offer discounts to accelerate receivables. They may sell excess inventory quickly to raise funds. These actions can push prices downward in certain segments, even when underlying demand has not collapsed. The result is uneven price movement across the economy. Financial indicators begin reflecting the stress with a delay. Bankruptcy filings increase gradually. Credit availability surveys show tighter standards. Delinquency rates rise in specific loan categories. None of these metrics alone define a crisis. Together, they reveal a consistent direction: reduced tolerance for risk and reduced availability of working capital. The most challenging aspect of this phase is perception. From the outside, there may be no headline event. Equity markets can remain stable, consumer spending may appear resilient in aggregate data, yet beneath these surface measures, operational decisions continue shifting toward conservation. The absence of dramatic news can create the impression that conditions are normal, even as liquidity continues to contract. This quiet adjustment makes the environment more difficult to interpret. Decision makers who rely only on broad indicators may underestimate the depth of tightening already underway. Those who monitor credit conditions, payment cycles, and supplier behavior often recognize the shift earlier. Their perspective comes from daily operations rather than quarterly statistics. Another systemic effect involves investment timing. When liquidity is uncertain, businesses delay expansion projects that require upfront capital. Equipment upgrades, facility improvements, and new product lines move to future planning cycles. The reduction in investment does not produce immediate layoffs, but it slows productivity growth and limits future capacity. Over several quarters, this hesitation accumulates. Manufacturers receive fewer orders for new machinery. Construction firms see fewer commercial projects break ground. Technology providers notice longer sales cycles. The slowdown spreads into sectors that initially appeared insulated from credit conditions. By the time official growth metrics weaken, the investment pipeline has already narrowed. Confidence within the financial system also evolves during this period. Banks, observing rising caution among borrowers, become even more selective. Risk models adjust to reflect new data. Credit committees favor shorter maturities and stronger collateral. These policies are designed to protect capital, yet they further reduce the flow of funds into the real economy. A feedback loop emerges. Tighter credit leads to reduced business activity. Reduced activity increases perceived risk. Higher perceived risk justifies tighter credit. Breaking the cycle typically requires either improved balance sheet strength among lenders or external support mechanisms. Without such changes, the system remains in a state of controlled contraction rather than active growth. Another important consequence is the redistribution of liquidity within the economy. Funds tend to migrate toward institutions and assets perceived as safer. Larger banks attract deposits. Short-term government securities see increased demand. Riskier lending segments shrink. This movement does not eliminate liquidity from the system entirely, but it concentrates it away from smaller enterprises. For communities that rely heavily on local businesses, the impact becomes visible in everyday activity. Storefront turnover increases. Service availability narrows. Employment opportunities become more limited. These changes often appear gradual, yet they reflect the cumulative effect of constrained working capital across many firms. Over time, the contraction influences strategic planning across industries. Companies begin prioritizing resilience over rapid expansion. Balance sheet strength becomes a competitive advantage. Access to multiple funding sources is treated as essential infrastructure rather than optional support. The experience reshapes how organizations evaluate risk for years after conditions stabilize. Throughout this phase, leading indicators remain critical. Rising bankruptcy filings signal that liquidity gaps have become unmanageable for some firms. Loan officer surveys reveal whether banks are still tightening or beginning to ease. Deposit trends show where confidence is flowing. Monitoring these signals provides earlier insight than waiting for broad economic statistics. The systemic consequence of a liquidity crunch is therefore not a single event, but a chain reaction. It begins with reduced credit availability. It spreads through operational decisions inside businesses. It reaches households through employment and income changes. It returns to the financial system through increased caution and concentrated liquidity. Each link reinforces the next. What makes this process particularly powerful is its incremental nature. At no single moment does the entire system stop. Instead, activity slows step by step. Options narrow gradually. By the time the cumulative effect becomes obvious, many adjustments have already been made across the economy. In such an environment, the difference between stability and distress often depends on preparation. Organizations with strong cash reserves and diversified funding maintain flexibility. Those dependent on continuous access to short-term credit face tighter constraints. The outcome is shaped less by sudden shocks and more by the steady pressure of limited liquidity. The broader lesson is clear. A liquidity crunch is not confined to banks or financial markets. It moves through payroll decisions, supplier relationships, investment plans, and household spending. Its path is quiet but comprehensive. By the time it appears in headline data, it has already influenced thousands of individual choices across the economic network. Understanding this chain reaction allows decision makers to interpret subtle signals with greater clarity. When credit becomes selective, when payment cycles lengthen, and when investment slows without an obvious external cause, the system may already be adjusting to reduce liquidity. Recognizing that adjustment early provides the time needed to respond before constraints become fixed. The process does not rely on dramatic events to create impact. It relies on the steady withdrawal of operating flexibility. And once that flexibility is reduced across enough participants, the entire economy begins to move at a slower, more cautious pace, one decision at a time.